Hello everyone, welcome to the explanation of our answers to our practice problems with regard to leases. We have three exercises or three leases. We're going to look at each one of them separately, and we're going to look at both the lessee and the lessor side. So first one is we determine is a finance lease because of the bargain purchase option. So at the end of the 10 years. So this is the formula we would use, remembering that when we use leases we have to put this 1 in here because the payments are made at the beginning of the period, not at the end. We have 10 payments, 9% interest, $34,000, and a $10,000 bargain purchase, which is treated as a last payment, if you will, at the end of the lease. So once we get that present value of $242,063, Alpha is going to record that. That's the lessee, I should say. For 242 and 242, the lease liability and leased asset, Santa, the lessor, is going to record it as sales. They're going to credit inventory and debit cost of goods sold because they are a dealer in this. So you can see this is going to result in some gross profit, sales and cost of goods sold on the income statement. This goes on the balance sheet, and of course the inventory is reduced on the balance sheet. The first payment is made immediately, and we get debit the liability and credit cash, and debit cash and credit receivable on Santa's side as soon as that payment is made. Then after 1 year, we're going to accrue interest. Now, this initial is when we use the present value. On a finance lease, this is now going to look just like a loan, and you're not going to use the present value again. You're just going to calculate the interest going forward. So interest for the year is determined by taking 9%, and make sure you subtract out this $34,000 out of your lease liability to calculate your interest. And then on the 31st, it's going to be recorded as a payable because you haven't paid it yet. And the opposite, which is the goal in these leases, is to have the two sides look the same. We'll see later that doesn't always happen. They're going to have revenue and interest receivable. So payable here, receivable here. And then because it is a finance lease, the lessee is going to record depreciation. This is now treated as if they owned it. And we're going to use the 12-year useful life because when a bargain purchase exists, we use the useful life, not the life of the lease, because we expect to have it all 12 years. So there is the depreciation for 12 years. The first day of the new year, we're going to make our payment of $34,000. That's going to debit this interest payable that we recorded at the end of last year. This should say, sorry, 1/1/2019, and debit the liability to reduce the liability. On the other side, you're doing just a mirror image. Get rid of the receivable and reduce the receivable, the lease receivable. Do the same thing the next year, another year of interest. This should be 19 again, and on the other side it is a receivable. All right, now exercise 2 is an operating lease. It does not fit any of the criteria to be a finance lease. So it is an operating lease. It's an operating lease that pays different amounts each year. So we listed those here. We add those up and we get an average, or if this was a straight line, meaning each year we pay the same amount, to get the same amount, it would be $6,600. So when we record lease expense and lease revenue, it should be at the $6,600, regardless of how much is paid. So that's the first thing we have to remember, is that you add up the payments. Anytime there's a different payment each year, then divide by the number of payments to get your straight line, as the FASB calls it, or average, if you will, however you want to think about it. And so as you go through this journal entry, lease revenue 6,600, is going to be each payment, and then you're going to debit cash for the amount of cash received, and unearned revenue is going to be the difference. And then once you were paying more than the 6,600, you're going to credit unearned revenue to make the journal entry balance. And on this side, on the lessee side, every time we record the amount of cash and the lease expense is 6,600, and the lease liability is going to be affected by the difference. See, in year 3 it's going to be the same, but other years it's going to be different. So in year 4 and 5 you're going to actually debit the lease liability. Now, there's nothing in the GAAP that says we have to use a term lease liability. We're going to be very flexible with that, but this needs to be a liability or an asset on the balance sheet, not an income statement. Can't be an expense, because the lease expense should be exactly $6,600 each year. Okay. Now, we also, on all operating leases, this is the new rule, do have to record an asset and a liability. That is the present value of these payments. Because they're different, you have to use net present value, and this is how you would get that formula. Now, net present value assumes payments at the end. So because it's a lease and the payments are at the beginning, we have to do this two-step process. Net present value, use the payments, the 4 payments, and then add the 6,000. So the 27,284 is using that. That's what your original amount of your leased asset and leased liability would be recorded. A year from now, when you make the payment, then you look at your lease asset and lease liability. The new present value, using the same net present value formula, is 23,411. So it has gone from 27 down to 23. That's a difference of 3,872. So we debit the lease liability and credit the lease asset. And then we do the same thing again. Notice that each year we are taking into consideration only the future payments. So the present value of the future payments. Your new present value is 18,800. Your difference is 45,89, and that becomes your journal entry amount. So you're correcting or changing your lease asset, lease liability each year. They're going down as the lease gets used up. So you might say that the leased asset is being used up, lease liability is being satisfied. So after the term of the lease, 5 years here, you will be at a point where there will be 0 lease liability and 0 leased asset. All right. So exercise 3, another finance lease. And this situation is we have what's called an unguaranteed residual. So the lessor is planning on getting back an asset at the end, but the lessee is not promising to give that in cash. Okay, so they're just promising to turn it back and hoping that it's worth what they said it would be. So the lessee in this case does the present value this way, ignoring that final return of the asset because they're not promising that. They don't have an obligation for that. The lessor, on the other hand, is planning on that, and so they include it. So their lease receivable is the same as the lease liability, but they also have this residual asset that they're going to get back. That's the present value of that $35,000. So their total is going to be the $282, which we said it was the cost of the machinery. So basically now they don't have the machinery anymore. They financed it, and they have this lease receivable and this residual asset. First payment, just like before, reduce the liability and the receivable. Calculate interest, but because this is a situation where this side is considering both the lease receivable and residual asset, both have interest, their interest amount is higher. It's based on the total of these two, not just on this lease liability. So this interest is based on this liability minus our first payment. This one is these two minus the first payment. Same interest rate, but it's going to be different. So this is a case where it's not the same on both sides. Depreciation, because this finance lease is done by the lessee, this time it is the life of the lease because you're going to return the asset. That's the assumption. Pay it off, make the payment the first day of the new year, pay off the payable, and the lease liability is reduced. Okay? Oh, this should be the lease interest receivable here. So we made a little mistake there. Wrong. Oh, wait a minute. That's my problem. L48. There. That's better. Now we have the right amount being paid off, and then this again would be the interest revenue would be not the same as this, would be based on the higher amount. But we want to make sure we know how to do this lessee side.